So, welcome back to Everything Marketplaces, where we talk with founders and leaders from some of today's top marketplaces. So, this is episode 143, which is a really incredible group chat that we just had with James Currier, who's a founding partner at NFX. So, James is, of course, someone that we all know in the world of marketplaces, since he's not only a leading mind when it comes to marketplaces and network effects, but is also an investor at NFX, which is a leading venture fund that's backed over 80 marketplaces like DoorDash, Lyft, Poshmark, Outdoorsy, Incredible Health, and more. So this is a really great chat with James, where we got to learn more about his previous operator experience and learnings that he's taken with him to now investing, network effects and why they make marketplaces great and defensible businesses, did an overview of NFX as a leading venture fund, got to learn more about how they evaluate marketplaces, discuss the differences between good and great marketplaces, some of the common marketplace pitfalls for founders to avoid, and also had a great group Q&A. So really enjoyed this conversation, and you're going to find it a great watch to the end. So James, welcome to the group chat. And as I mentioned to you right before we hit record, you've been one of the most requested group chat guests since we first started the community. So this is a real treat to have you join us here today. And wanted to start off by saying, huge thanks for taking the time to do so in advance. So I'm looking forward to diving into more on network effects and all your incredible experience investing in marketplaces at NFX. But I thought it might be great if you can briefly, share a little bit more on your background for those that might not know you, and then what led you to network effects and marketplaces.
Sure. Well, great to meet you all. Thanks for coming today. So look, I grew up in the Boston area. I did the whole Exeter, Princeton, Harvard Business School thing. And before HBS, I worked at a venture firm called Battery Ventures. I was smiling and dialing. I was an associate helping to sell money to founders, basically, when there was only 40 active venture firms in the whole world. So it was very early on. And I started businesses. Instead of going back into venture after business school, I decided to start a company. We didn't have network effects. And when we got acquired by a marketplace called Monster.com, a marketplace between employers and employees, I realized that I had really missed the boat in building a company that had no network effects. This was about 2004. And so I became obsessed with network effects. I became a student of them. And it turns out that marketplace network effects is only one type of network effect. And of course, we started seeing, direct network effects with social networking and email and other things. So I started to tease out the differences between them. And by the late 2000s, I really was focused on marketplaces. So I made investments in Poshmark and in Lyft and in DoorDash and these, Goodreads and these sorts of things. So that's how I got into it. And that's why I became obsessed.
No, that's a really great background, and thanks for sharing with us on that. So definitely a lot we can get into, and even reference like your post as far as what we had the 16 types of network effects.
I think so. I think there might be 17 now, but yeah.
So I guess kind of going back though, to your founder and kind of operator experience, were there any other kind of like specific kind of learnings or maybe like key insights that you've taken with you to maybe thinking about how you invest in marketplaces today?
Yeah, I mean, there's a ton, right? I mean, each marketplace is so unique. And the big thing I think that I came to realize is how difficult they are to fly. So often, like, you'll create a SaaS business, and then you'll evolve the product every now and again. But really, you're just innovating on sales once you've figured out what your go-to-market and your product is. With marketplaces, you literally have seasons, or you have innings of a baseball game. There's literally like 9 or more, and you have to keep changing what you're doing and what you're emphasizing at different phases of growth as you get more demand or more supply or more this or more competition. And so they're difficult to fly. It takes a really skilled pilot looking at a lot of metrics to understand how to make these things work, and certainly how to make them bigger. And so you'll have companies like Fiverr, which will start small and very compact, and everyone will say, oh, that'll never be big. And then it gets to be worth 6, 8, 7, 8 billion. And they really can't grow from there. They just sort of asymptote out because they can't figure out what the next inning is. So even the successful ones have a tough time. I mean, you've seen what happened with Lyft right now, where it's, that network effect is collapsing. So that's sort of the overall picture about marketplaces, that they're all unique and it's a very difficult plane to fly.
Yeah, that's a really great point as far as them being unique, right? Like a lot of times you try to, point and kind of compare what we're building to others. So
a lot of firms have said, look, I'm building a platform for people to build marketplaces. I'm going to build the infrastructure, the software, and that never works because each marketplace is so different based on the vertical or the angle they're coming in or the or even the channel that they're acquiring customers from, and then the phase of when that marketplace is happening. Is it 2019? Is it 2023? Is it 2020? It's all different. So the software has to be so unique to service each of these things that those platforms never will.
Yeah, certainly. We'll probably jump into some of the topics as far as, like what we're seeing with some of those kind of go-to-market strategies here, today in a little bit. But I guess, most of us here, of course, know NFX. But could you give us like a brief overview of it as a venture fund today?
Sure. So NFX is, if not the largest, one of the largest seed funds in the world. We've got a $450 million fund. We just do seed investments. Our average check size, $3 million. Average ownership is about 16.5%. Got about 165 investments now. We've been around since 2017. We have 5 partners that are all equal. And 4 of us invest in marketplaces. And so, probably 56% of the companies we invest in have some sort of marketplace element to them. I mean, it's more than half of all the companies we invest in. We've got offices in San Francisco. We've got offices in Tel Aviv. So that's about all of our investors are institutions like colleges and endowments and those foundations and that sort of thing. And we don't take a salary. We're doing this for sport. We're doing this to have an impact and really help founders. It's what we love doing. We love whiteboarding. We like working with you. So after we invest, we'll meet with you every week until you're sick of us, because we like the building process with you. We could make a lot more money investing later stage, but that's not who we are. We're builders. And I think that among us, we've built and sold over $10 billion worth of companies ourselves, which is twice as much as Horowitz and Andreessen when they started that firm.
Yeah, you definitely have an awesome platform and products and kind of resources that you've created. So
yeah, we're the second most trafficked VC website in the world after Andreessen. So it's Andreessen, us, Sequoia, and First Round, and then it drops off pretty substantially after that, just of all the content we build. And so obviously, if you just go to Google and type in NFX library marketplaces, you'll get a good page. Or if you just go into the content area and you scroll down, you'll get to a marketplaces area down there. We actually put the marketplaces area down lower because it makes people, it's like putting the milk in the back of the supermarket. Everyone wants the milk, so they will scroll through the other stuff first so you can find it. There's a ton of stuff we've written about marketplace.
Yeah, no, it's always being referenced in the community, so it's great. So you mentioned as far as really kind of rolling up your sleeves and working with founders. So could you maybe share an example of like a recent marketplace that you've invested in, and kind of how you've worked with the founder and the team?
There's a company called Octo, AUCTO, and they are doing a B2B marketplace for used assets in the automotive and energy sectors. And we like these B2B marketplaces, particularly used equipment, because they have individual SKUs. If you don't have an individual SKU, then it's just an e-commerce site. It's harder, I think, in many cases to build a marketplace. So we actually favor used equipment. And these guys, cold emailed me out of Toronto, and I've been working with them now for 2 years. And once I got involved, we decided that the main thing to do is to build a sort of inventory management system for SaaS embedding for the supply side, because it's a supply side marketplace. We had worked with Incredible Health in the past, and they had been doing a different business when they came to us, and we actually suggested this business to them, which was basically Hired for healthcare, and Hired died because they couldn't get lock-in on the demand side, because it's a demand-driven marketplace. Those types of labor marketplaces are more demand-driven. And so they were unable to get lock-in, whereas Incredible Health, by building software for the hospitals, was able to get lock-in. And on the demand side, which is what you need in that particular marketplace. And so we just used the other thing on the supply side for Octo, and that's something that we'll typically do. And then, we introduced them to some folks who have been working at Facebook, and so they've joined. And so now the speed and the cadence are up to sort of Silicon Valley standards. The team is now moving to Silicon Valley, and they've just raised their A that they haven't announced yet. And so it's putting the pieces together and figuring out what a particular marketplace needs, and then designing for that and surviving until you get the next round.
And those are two really good examples. And as I mentioned to you, Amon from Incredible Health was a previous group chat guest, and that was such a good group chat that we had with her.
So. Yeah. Yeah, no, it was interesting. I worked with her for about 6 weeks to like come up with the idea. And actually, I think I helped her. Yeah, I gave her the name Incredible Health. Like we were whiteboarding in my garage, literally, in Palo Alto. And I wrote up Incredible Health. She's like, well, and so she was like, yeah, I like that one. Boom, off she went.
That's really cool to hear. So as far as like when it comes to evaluating marketplaces, you've actually shared a post as far as like the NFX kind of marketplace scorecard, and they could probably be an entire kind of group chat, just discussing that. But what are some I would say like some of the specific things that kind of stand out now, maybe that you look for when you're evaluating marketplaces?
First of all, with the scorecard, realize that when you go through the scorecard, you're going to score yourself like 22 or 23 out of 26. It's just not true. Almost every founder I've seen scores themselves like 22 or 23 out of 26. And this is like 1,200 different marketplace founders have all scored themselves almost 100%. And you have to be a little more honest with yourself about where you are at with the scorecard. I will score you differently, most likely. So that's one thing to know about scorecard. The second thing that may or may not be in there, I can't really remember, is one thing we've realized is that heterogeneity and homogeneity, where you are on that spectrum, is very important. If you are too homogeneous, like an Uber, where every rider pretty much wants the same thing and every driver pretty much does the same thing, it's very difficult to win unless you just have overwhelming firepower, which is what Uber did. And sort of nature of Travis and his approach, and that time when there was zero interest rates and the ability to raise money was so unique that they've managed to build business, which is now only 13 years in, beginning to have a quarter of profitability. And on the other hand, and so it's very, very difficult. So everybody else has died, right? Think about it. Like you have Didi and you have Uber and everybody else has died. And then on the other hand, if you have too much heterogeneity, you have too many different types of demand from the supply side, too many different types of product, too much. It's usually a demand side problem where the needs of like a lot of people who try to create marketplace or marketing services, labor marketplaces, right? So people doing, brochures, people doing websites, people doing design, people doing copy. A lot of people have tried to build that marketplace. And in the end, it fails because of the heterogeneity of the demand side. It's just too much heterogeneity. And so it doesn't coalesce into a real marketplace. And so there's some sort of Goldilocks zone in the middle between those two things that we should all be looking for, where there's enough heterogeneity so that you need a marketplace, but there's enough homogeneity so it's not an infinitely sized concept set, and therefore it never coalesces. So anyway, that's one thing that we've learned to understand more recently when looking at companies.
Yeah, that's a really good one. So I'm sure that's going to lead to some questions from some founders here. So I guess kind of somewhat related to that. When you're evaluating marketplaces, what do you kind of think are like some of the key things that like I would say differentiate from like the good to the really great marketplaces? And is that something that you can kind of spot from the very early stages?
Yeah, I mean what you're looking for is high AOV and high frequency, right? So you have to plot that chart and say, where am I? And if you are inside the boundary layer, then you don't really have a business. If you're inside a boundary layer, I don't know where that boundary layer is on your chart, but you draw sort of a red line and a curve there and say, look, if I have enough frequency, even if it's a low AOV, I can build a business. And if I have a high enough AOV, average order value, or average sales price, ASP, but I don't need that much frequency in order to build a big business. So a good example of that would be like University of Phoenix, where they're charging people for 2 years times $8,000. So it's $16,000 ASP. You don't need that many people before you end up with a pretty big marketplace. Or, the example we give is if you look at Zynga, right? So there was a gaming company, and they're not a marketplace, but they demonstrated this by showing that they could have Farmville, where they were making 4 cents a day per user. They had 100 million people, and that was a business. And then they had Mafia Wars, and then we had Dragons of Atlantis as a gaming company that was doing like $3.40 a day per user, so much more than 4 cents a day. But we didn't have that many users; we only had like 200,000 users. But both of us had businesses, and then the best businesses was Mafia Wars because they had they had like $1.80 per day, and they had 90 million users or 80 million users. And so that was that Mafia Wars was the core of Zynga's business because they had both high AOV and high frequency, and so or large number of users. So those are the core things you look for, and then again, you really have to look at metrics driven CEOs and metric driven teams because these things are so hard to manage and to fly. These planes are hard to fly. Like, you have to be good at looking at your white hot centers and your subsegments on both the supply and the demand side. You have to notice the difference between certain types of buyers in the data, and then start to skew experiences for them, or funnels for them, or marketing for them, that sort of thing. So there's just a lot of detail orientation around that.
Yeah. So I'm glad you brought up the the mention as far as the white hot center, because that that was referenced in the questions. So could you maybe kind of like walk us through that as far as like that kind of concept and what you're referring to?
The basic idea of the white hot center is that you can have transactions, but if you really look closely at your data, what you'll notice is that there's a particular group of people who are accounting for most of the activity, most of the retention, highest AOVs, some sort of beneficial metrics associated with those particular nodes in your network. And you need to identify them and then target them. So for instance, we had a company that was doing something like FAIRE, FAIRE, where they were looking at sort of B2B sales of craft equipment, craft goods. And it wasn't going very well. They'd been at it for 2 years. They came to me. We put in a few $100,000 and started working with them on the whiteboards and figuring stuff out and looking at data. And we didn't necessarily see a path with that team to creating another type of affair. We said, but who are the people? We finally got them to look at the data and find their white hot center. When they did, they found out that these were interior designers who were using it to buy certain things. So we said, why don't you just reconfigure the business to just focus on interior designers? And they eventually created a company called Ivy Mark, and then focused on them, and they got acquired by House for lots of reasons. They could have been a $400 or $500 million exit had they played it differently, but that was the white hot center within their overall transaction volume. And once they focused on it and recommitted to that group exclusively, then things really started to pick up. And that's what I kind of need.
Yeah, that's a good example. And I feel like somewhat related to that is a topic we were always talking about here as founders in the community is, expansion, right? And, if and when to expand. And how important it is, when it comes to like a sequencing, standpoint. So, I guess like if we kind of go back to maybe an example of like an early stage marketplace, like another one, how do you kind of help them think through, if and when the right time to expand is?
Yeah. So you've got geographic expansion and you've got category expansion, and there's no hard and fast rules. I mean, with Poshmark, we had this issue where we were focused mostly on women's clothing. And then it became women's accessories, and then it became furniture, then it be, lamps and couches and decorations in the interior. Like, that started to get a little, and then there was a question of should we let that flourish or not? Was that going to be a real driver, or was that going to be a deadener to the commerce and the community? And then the question is, do we expand into children? And then do we expand into men? And there was a lot of debate about this. And in the end, we held off as long as we could to just focus on women's clothing and accessories, because we wanted that to burn white hot, and we wanted to make sure that Depop and everybody else who was entering the market would have a hard time sort of undermining our core. And we kind of delayed, and then eventually we had to open it up. But it was probably about 4 years after we thought about doing it. Simply because we needed to get the core business, tuned higher and higher and scale larger and larger. And, it was more important to add in, let's say, stylists and the ability for people to have a stylist profile in addition to their buyer profile or their seller profile. That was more important than us expanding into men. Um, and so I don't know that I have a particular rule of thumb, but you just have to look at the data about your growth rates, about your retention rates, where the competition is, how much money the competition is raised, how much you're spending, to decide whether you own your white hot center or not yet. And if you don't, then you got to stay focused until you own it. Yeah. And sometimes it can get screwed up by VCs, right? Because the VCs and investors will throw money at some of your competitors, and then you're all going to have ruinous competition until somebody dies. Like there's a marketplace called Convoy in the shipping and the trucking area in the United States that raised $800 million, and they just shut down 2 weeks ago. I mean, zero back. Everybody gets fired. Like it was a mess because there was just ruinous competition. It was overspending, and they didn't navigate the debt properly. They didn't navigate the downturn in the freight market properly. They didn't navigate the interest rates properly. So when all that happened, the company just imploded and nobody even bought them.
Yeah, it's definitely glad you brought up that last point. So you've mentioned quite a few times here as far as the focus on the founder, right, and kind of being metrics driven and really understanding that. So are there any other kind of like characteristics or maybe traits of that you've kind of seen with some of the best founders that you've worked with?
Yeah. So number one, they need to be metrics focused from the top, and so that ensures that everybody in the organization will be metrics focused. Some people I'll tell you why I invested in DoorDash was because I had looked at the other 4 sort of delivery companies at the time, and they were all really interested in the experience of the food, right? They were really into the experience, the passion for food. And the DoorDash guys couldn't give a crap about food. They just cared about numbers. They were literally just metrics driven. They were a logistics company. And I was like, well, the logistics company is going to beat the foodies every time. And so, a lot of people get into different businesses for different reasons, but really you have to care about the metrics. So that's sort of the first thing. The second thing is that as you go through these seasons, there are going to be people who are going to be helpful to you during a particular season who will be a hindrance to you in a different season. And so the turnover in some of these marketplaces companies is quite high. And so you have to be willing and good at recruiting as well as letting people go. And you have to be willing to do that. And so that's another thing, that the more ruthless, if you will, founders have proven to be better in that regard. And it doesn't mean that the people who are good for one season aren't good people or are talented. It just means that they're not a fit for the next season because what the business needs is very different. And then the other thing that we've noticed is that the CEOs need to be good, particularly on the B2B side. They need to be very good at PR because you've got to massage the existing people in the market, particularly if there's brokers or other folks who are going to be displaced by what you're doing. There are these seasons where you have to kind of sneak up on the market before they see you coming, because otherwise they will just not use your stuff, knowing that it's about to impact their own margins. So you have to be very good at PR in that way, thoughtful.
No, you got a lot of head nods here. So we have quite a few B2B marketplace founders in the community. So definitely relatable on that. So I guess that's somewhat related to that. As far as I feel like we're seeing the kind of the rise of B2B marketplaces, right? Like when it comes to kind of trends and opportunities. I actually was going back and listening to one of your chats, previously, where you mentioned where you thought that you might invest like 50% kind of in consumer and then 50% B2B with NFX. But it's looks a little bit more kind of like 80-20 B2B. So do you on that note, do you feel like it's as far as maybe consumers kind of more competitive, or like there's just like kind of more white space in B2B, or how do you kind of think about that?
Yeah, I think both is true. I think there's more white space in B2B. I mean, a lot of the business folks have been slow to adopt software, whereas the consumers adopted it very quickly, both with their laptops and with their iPhones. And I think that look, anything that's exciting and colorful, a lot of people gravitate to, right? So when we talk about our big wins, we still talk about, DoorDash and Lyft and Poshmark and whatnot, because these are things that people know. And so there's just more competition from founders and VCs who want to invest in colorful things that people know. Whereas, the first, B2B marketplace case study Harvard Business School ever did, they just did it 2 years ago. So it's kind of just getting going. It's Move.co is the name of the case, and it's one of our companies. And it was the protagonist is the CEO, Steven Zhu, and me, and whether we should invest in them or not. And so the B2B stuff is just being researched because it's kind of boring, and it's not as colorful, not as quick to grow. You have to really understand and care about a lot of esoterica, and most people aren't willing to do that. But they're more interested in shoes, they're more interested in food, right? They're in travel. It's like all the fun stuff, yoga. Like that's what most people like. And so yeah, I think if you're looking for really good hardcore businesses, you're going to be in the B2B phase this decade.
Certainly. I feel like on the other end of that too, as far as when it comes to investors too, as far as AI right now. So
yeah, and obviously we're adding a lot of AI to our marketplaces. So.
Yeah, Pete had a great post on that, recently, of course, as far as AI first marketplace that was referenced in the community. So I guess to kind of cover that in a little bit of detail here for founders on the chat, could you maybe share some examples of how you're seeing kind of marketplaces leverage AI right now, maybe?
Yeah, I mean, the basic idea is like, how can you reduce friction for both the supply and the demand? How can you use the sort of auto tug features of AI to go out and do work for people so they don't have to do it, so that the transactions can just show up for them, or they can onboard their supply effortlessly, or use AI to help the demand side sift through and make short lists of what they might consider buying. I think we've got probably 17 different ways of applying AI at this point to different marketplaces. But those are sort of the top of the list.
Yeah, I'll definitely reference the post again here for everyone. So we're going to get into questions here in a little bit. Otherwise, I could just go on talking about topics here. I'm going to get some notes from founders here. But right before we do though, so you of course see so many marketplaces. Have a lot of awesome kind of insights into them. So are there maybe any specific kind of pitfalls that you see kind of early stage place for marketplace founders?
Pitfalls. I mean, the pitfalls for marketplace founders are the same as everyone else, and then some, because they're difficult to fly, right? So, the first thing is you got to make sure you got the right team. And that the biggest problem that founders have is that they don't have the right team, or that they aren't being the right team member, or that they don't have the right skills. That's the first thing. I think the second thing is, again, picking the right market. I think that, if we have this rubric, if you go to sort of NFX, sort of patterns of startup ideas, it sort of lays this out that, after looking at tens of thousands of companies over 30 years, I can tell you whether I can put your business into one of three buckets. It's going to waste your life's energies, I don't know, and fertile soil. And the fertile soil is about 10%. The I don't know is about 30%. And I can definitely tell you this is going to waste your life's energies on 60%. And so the goal is to try to move yourself from one to the next until you're in the fertile soil. So the second thing is just picking the right hill to go after is sort of the second thing. And then the third thing is making sure you're properly capitalized, because these things always take longer than you think. I think I started working on Poshmark, and I think he was writing the business plan on my floor at my house in 2011. That's 12 years ago. These things take a long time. And in a lot of marketplaces, you don't start to see a lot of success until year 6 or 7. I think OpenTable was selling SaaS software for 7 years before they opened the marketplace. So you have to be patient with these things, and it takes a lot longer than you think. And so you have to make sure that's properly capitalized.
No, those are really great. So definitely it takes a lot longer. So I can admit that myself as a founder. So cool. So we're going to get into questions here. Let's see, because we had quite a few. So if you had a question, you can you just use the raise hand functionality. Hey, Max, did you want to jump on?
Sure. Look at that. Hey there. Thanks for doing this. This is awesome. Learn a lot. So Max, I'm from Epicurate, and I was really wondering about, as marketplaces vertically integrate, do you think that companies like Airbnb are going to start buying, the property management systems that they, their hosts rely on, and we'll start to really see more acquisitions like that?
Yeah, it's interesting. I I think my gut take right now is that you're going to see fewer and fewer acquisitions. That as AI is making software easier to develop, and that as companies are learning that copying their competitors is okay to do, which has not been part of the Silicon Valley culture for years, but is becoming increasingly normalized as Facebook and Google basically didn't invent anything. They just copied everybody. I think you're going to see fewer and fewer acquisitions. I think that, there have been so few tech acquisitions that have actually worked out for the acquirer. Some of them are really big, like PayPal and Instagram, but most of them don't work out. So in general, I think you're going to see diminishment of M&A as software gets easier to develop with AI. And but do I think that you're going to have more and more vertical integration? Yes, I think you're going to have Airbnb expand out into campgrounds, and they'll try to get into RVs, and where Outdoorsy is getting into campgrounds, and then they will get into houses. And everyone's going to expand horizontally, and then they are also going to expand vertically, either by building or buying. And I just think that the number of times that they decide that buying is the best option is going to diminish versus what it was 10 years ago.
Do you think that they'll look into more of the management system for the host?
I think they might. I think the general decision they're going to make is going to be, do we need to have them, is that already sufficiently fractured? And is there too much heterogeneity there? So we don't want to own one particular type of software. We actually want to create an API so that all of those can connect in, and we can serve different verticals more easily that way. Or do they find enough homogeneity? It's got to come back to the heterogeneity, homogeneity line. If the needs of what you're talking about are pretty homogeneous, then they might buy one and then try to crush everybody else. But if they find that those needs are heterogeneous, then they're going to want to create an API and then have that be a third-party system and then suck as much value out of each of them as they possibly can because they own the distribution.
Good question. Thanks. Let's see. Hey, Bo, I think you were first to raise your hand. I know you added that question to the doc too. So
yeah, happy to ask it. So James, my question centers around, reading through the blog posts, it's clear that you believe LLMs will have a huge impact on marketplaces. Yeah. One thing that's not clear to me is whether that innovation will be primarily horizontally. Example given, someone building an LLM service for connecting supply and demand across all marketplaces, similar to what Twilio did for SMS, or if the innovation will be so training data dependent that it'll only take place vertically or within a specific company. Example given, Upwork building the leading services chatbot because of their advantage in training data. I'm kind of interested to hear your thoughts on which direction do you think the market will evolve and why?
Yeah, I mean, this is one of my core theses that people are overestimating the value of proprietary data. So as my angle into answering your question, it's going to come from that perspective. That if you go to Google and type in data network effects, the first article is that about my skepticism about the existence of data network effects. Now, my marketing team made me change the title so that it wouldn't be so negative, but because people love to believe in network effects and proprietary data. And I'll tell you why. It's because Google and Microsoft keep telling Wall Street, we're going to win because we have the data and we have proprietary data. And the reason those companies do that is to keep Wall Street investing in them, number one. Number two, to keep their employees from leaving. Like, well, how would you leave and start a startup? You're going to have no data. And you know that because we have the data, we're going to win. So this, I think, is a myth that they create, because I can synthesize your data, I can steal your data, I can cobble together other data sources that aren't yours, and I can get very good approximations. And as these models get better and better, my solution will become 98.8% accurate, and yours will be 99.2%, and the customers can't tell the difference. And so I don't find. I think Upwork's lead is maybe 4 to 6 months. In terms of this. And if I really wanted to create something that did what the Upwork bot does, I could do it. Got it. So I suspect it's going to be more horizontal in nature. I think the reality is going to be more catch as catch can over the next 2 to 3 years as this whole thing starts to settle out and everyone understands the game. And, but I would not over-index on your proprietary data thesis. I think I think there's going to be very, very few cases where that ends up being persistent.
Got it. Thank you.
Thanks for that. Hey, Chris, do you want to jump on?
Yeah, absolutely. Thanks heaps, James. Awesome having you here. And I really enjoyed that you were talking about metrics because that's what my question is related to. So what kind of fidelity do you expect and think is ideal for your metric tracking and dashboards at different stages? Because when we've spoken to investors and we have investors, if we were to only listen to investors, we would almost spend all of our time building metric dashboards potentially. And so how do you balance that, given that you've been on both sides of the table with sales taking action, the gritty stuff that maybe is a little harder to point to versus the measurement piece? And for context, B2B marketplace, high ticket value, high frequency, in case that helps.
Yeah, I think the question is really sort of, it's important to use metrics to make your decisions, but how much is too much? And so you're absolutely right. We had Bill Gurley on our board at Second Life, and we would have these board meetings that would be 4 hours long, and Bill would spend 2 hours like looking at, line 48, page 27. And I'm just like, really? Because he was a Wall Street analyst before, and that's how he saw the world. And it was a disaster. It was ruinous. So I get what you're talking about. Look, I think that often here's one thing where you could be self-critical. Often investors are asking you either because they're stupid and they don't know what to say and they want to sound smart and sort of, that's their problem. And you should recognize that and ignore them if they're just being, I'm smarter, I'm going to ask you these questions. Or they're asking you because they don't think that you're doing a sufficient job of controlling it and doing the queries yourself. Like, if you are very efficient at making your own queries and very efficient looking at your data, then they won't be asking so many questions because they'll feel you have it in hand. And so sometimes you get into this cycle where the founders don't realize that they're not very good at it. And so then you end up, all the board members keep asking for more and more reports, just trying to spur the founder to get interested in their metrics, to get clever and smart about what they're looking at, and ignoring that data, but really focusing on that data, laying out the data in this way or that way. I was just working with one of our analysts yesterday, and, he's learning how to do that. And he sent me a spreadsheet, and it was, not very good. And so I had to go spend a couple hours, moving the data around, collecting more data, augmenting it, and then showing him and putting the colors on it, ranking things in various ways, adding new columns, so that we could actually look and make decisions and get conviction about something. And he was like, wow, I thank you for showing me this, blah, blah, blah. We'll see if he learns or not. But the point is, this is an ex-McKinsey guy, this is a Stanford guy, this is a 28-year-old, and he still doesn't know how to do it well. Maybe you don't know it well enough so that your investors feel confident. That would be something I would look at, because it could be them because they're stupid and they're trying to be imperious, try to LARP. You guys know LARPing, live action role playing. They're LARPing as a board member. But it might be that you're LARPing as a CEO and you actually need to get down and more nitty gritty in it. And I think Bill Gurley kept poking on these numbers in part because he didn't feel that Philip was, doing a sufficient job of combing through the numbers, which actually wasn't true in Philip's case. And the way we would do it in my company is that Stan and I would just sit around on Saturday mornings, eating chocolate croissant and just typing in SQL queries because it was fun. I wonder about this. I wonder about that. And then we would sort of navigate through our data and then come up with insights to help us make decisions.
Thanks for the question. Hey, James, I actually had a question. Someone messaged me and it was added to the doc in advance as well. But as far as when it comes to kind of, I would say like metrics or benchmarks for raising a seed round right now in the the current fundraising environment, from NFX, what are some, I guess, kind of like ballparks we could use for that?
I mean, we had somebody come through here the other day with a marketplace. They haven't even launched it, and we would consider investing in it simply because of the idea and the team, and we would consider putting in $2 to $3 million to help them get going. And so there are those conditions because we had a prepared mind about a particular area, and they came with that exact thesis. And so we're like, well, we've been thinking about this. This makes sense to us. So there are those cases for a seed. Typically, we'd like to see a product built, and we'd like to see some transactions taking place, so that we can gauge sort of what's the actual potential take rate, what's the actual AOV. Are we going to be able to get broad enough so that we can find our white hot center in the next phase and focus in? Will our $2 to $3 million be sufficient to help them get there? Do they need to raise $5 million? And we'll put in like 3.4 or something and bring around together. So there's lots of factors in that. But generally, again, like we want to see the right AOV, we want to see the right frequency / retention in order to believe that there's a big market there. The other thing is, sometimes we don't need to have a big market initially. We just need to know that they're going to have a white hot center, and then we'll figure it out later. That's another thing. But we just need to know there's a really, really white hot center that we believe in. Now, in terms of Series A, I mean, we've seen companies with, $600 million GMV, 18% take rate, have a hard time in the Series A markets, right? It's tough out there. The Series A dollars, Series B dollars are sitting on the sidelines. Everyone's trying to invest in seeds because they can deploy $2-3 million and not really worry about it because they're a big fund. So it's tough for the A's and the B's right now.
That's going to be really helpful. So certainly relatable as far as for me out there, as far as being tough. So we're going to try to squeeze in. We'll get one last question in here. Hey, Kyle, do you want to come on?
Yeah. Hey, what's up, James? Thank you for your time and your insights. It's nice to hear an East Coast perspective and hearing a lot of West Coast. My question goes back to an earlier comment you made around Lyft, and it sounded like their network effect is kind of staggering a bit. I was hoping you could kind of share some more insights on that and maybe how we can, as marketplace operators, make our network effects a little bit more defensible.
Yeah, so I think what happened if you go back to NFX and type in like NFX Uber, you'll get an article that we wrote 4 or 5 years ago about Uber and how their network effects just aren't that defensible. And yet nobody's been able to challenge them because of their size and scale. And what has happened in the last couple of years with Lyft is that as their network effect in their various regions has diminished, as their market share has gone from 60% to 50 to 40 to 30 to 20% market share versus Uber in various cities around the US, those individual network effects, which are regional, have collapsed. So you look at Boston. Boston used to be the number 2 tech center. It's now number 4 or 5 because the city's tech ecosystem just collapsed after enough people were stolen out of it into San Francisco and New York. And the same thing's happening to Lyft, and which is unfortunate because I prefer the brand and I prefer the management to the Uber, and I was an investor. But I mean, obviously, I got out years ago. But what ends up happening is the fewer drivers you have, the longer the wait times. And the fewer drivers you have, the more you have to pay them to keep them on the network. And so, and the less money you have in the bank, the more margin you have to take in order to keep going. And so your prices end up being higher. So if you look at Lyft and Uber in San Francisco, over the last year, I've had to move off of Lyft onto Uber just because it's always cheaper. And they're always faster just because of a network effect. And so the way that Lyft would have managed through that, I don't think it's savable anymore. I think they've got $1 billion of debt and they're burning $500 million a year, and I think they got $2 billion in the bank or something. So that gives them about 2 years of cash, unless they fire half the people, which they probably could. But anyway, the only way to do it is to keep incentivizing the supply side. It turns out that this is a supply side market, that as long as you have supply, you will have a lot of demand. But the problem is finding and retaining your supply side. And so they just needed to have focused on that. And that's how Uber ended up becoming more indefensible. Now, the other thing Uber did was they got into the DoorDash business, which ended up being the better business, which was hard to know, 13 years ago, 14 years ago. But turns out that DoorDash has the higher frequency and the higher AOV. And so that has really propped up Uber in order to get their metrics to the point where they can sustain on the ride share side long enough so that Lyft just dies. So in terms of making your stuff more defensible, you've got to figure out who the key nodes are and do whatever it takes to keep them there. Like, you think about, if you go to the article on NFX called Network Bonding Theory, that's like the mother lode of sort of interesting thinking about this. It's not an article that a lot of people reference because it sounds so boring. But there's actually a big example about Messi in there and his network, sort of adding that node into a network and its effect on that network. And if you start to think that way, you'll realize that there might be in your marketplace, there might be 8 or 10 people who you're willing to like give them 2% of the company each in order to keep them on your marketplace. Because if you do that, then the other nodes on the supply side coalesce, and then all the demand comes to you, and you end up winning, and you only gave up 14, 15% of your company. Do that with them rather than doing it with the VCs, and
That's great. Thank you.
Yeah.
Defensibility was a great last question to wrap things up. So we're almost out of time here, but James, we really appreciate taking the time to join us here today. And once again, this is a real treat to have you join us. So you're a highly requested group chat guest, and we're all big fans of all your great posts that you've shared, and of course NFX. I had one last question though for you right before we wrap things up, and that's if you could go right back to before you entered the world of marketplaces, what would you tell yourself about them specifically?
I would have told myself, focus on consumer because it's only going to last a certain amount of time, and then switch over to B2B. I think we switched over to B2B at the right time, but it wasn't with any foresight. It was literally just by talking to founders and then seeing what was available and saying, that's actually interesting. Which I think is why we ended up, sort of being on the forefront of all that. But it wasn't through any sort of prescience. You have to understand the cycle that you're in. I mean, realize, guys, that the whole venture cycle is sort of coming to an end. Like we've had, hedge funds were good between 90 and 2012, and they've had a really hard time for the last 11 years beating the S&P 500. And mutual funds used to beat the S&P 500, but by the early 90s, after about 20 years, they weren't. They're about 1 out of 5 per year, would beat the S&P 500. And I think the same thing's going to happen to venture capital. So it itself is in a cycle. I think when I started in the venture industry, there was 150 people doing my job. I think there's over about 40,000 now. I think on Signal.NFX is almost 32,000 just there alone. There's got to be another 8,000 who haven't built their profiles. So call it 40,000 people doing my job. Like that's unbelievable. From 150 people to 40,000 people doing this job over the last 30 years. Where we're at a different part of the cycle. And so you need to understand where you are in the cycle of your industry or in marketplaces in general, or startups in general. And it's all been going up and to the right up until, 2 years ago for the last, 20, 30 years. But it's going to be commoditized. Software is going to be commoditized. The methods, like I'm talking to a lot of people here. I don't know, there's 4 pages of us, right? So a lot of people are learning the secrets. In order for us to get deal flow, we publish all of our secrets. And so the playbooks are becoming more and more known, which means your information advantage is diminishing. So everyone, it's just at a different part of the cycle. And so I kind of backed into marketplaces because we got acquired by a marketplace in 2004. It was at the right time, but you need to understand where you are in the cycle, I guess. That's what I tell myself.
That's a really great point. So, well, cool. So yeah, we once again, I really appreciate it. And then where can we keep up with you or reach out to you?
Well, you got to subscribe to the NFX newsletter. And then, I've got a Twitter and I've got a LinkedIn.
We should all be following you anyways, but if not, I'll include links here so that way we all can. So,
okay. Well, guys, it's great to meet you all and go get them. I'm so glad you guys are doing what you're doing.
Appreciate it. Yeah. Thanks everyone for joining in today and the great questions.